Welcome. I'm Steve Brennan, Head of Private Wealth Solutions at Hamilton Lane. We're pleased that you could join us. Today's topic is 2025 Private Markets Outlook and Public Market Implications. Our panelists will discuss the current and future state of both private and public markets, including a review of some of the biggest events in 2024, like the U.S. election and other geopolitical changes that could impact markets in 2025. A brief introduction to our panelists. Mario Giannini is Executive Co-Chairman of Hamilton Lane. Previously, Mario was CEO of Hamilton Lane for 22 years. Mario is a private markets industry legend, well known for his perspective on the markets and economy at large. Blaine Rollins is a Managing Director at Hamilton Lane, responsible for private wealth market strategy and insights. He's the author of our U.S. Weekly Research Briefing, which has over 80,000 subscribers. So first, we've heard a lot about the convergence of private equity and public equity recently. Can you talk for a minute about what that means in your mind and what the broader market implications might be?
Sure. So convergence is a fancy word to mean that they are increasingly becoming one asset class, equity. And what's happening is, I had a call from the head of a U.S. pension fund who said to me, I am going to increase my allocation to private equity. And I said, you don't like private equity. You think we're all greedy, horrible people. And he said, you are. And I'm not changing my mind on that, but here's what's happening. What I used to have in my public equity portfolio, the range of stock, the range of companies, is diminishing. You know, in the US, over half of public companies have disappeared in the last 25 years. And increasingly, they're in the private side, and they're staying private longer. And that's where you get access to a lot of the companies that used to be in the public world. I mean, in what environment? Last year, OpenAI raised $5 billion at a $150 billion valuation. Like, that just didn't happen 10 years ago. So the convergence is that the public and private world are increasingly becoming one place to invest along the equity scheme. And so you have to have exposure to the private side in order to have exposure to the companies that you used to have as part of your public equity portfolio. And the same is happening on the credit side. You've seen all this discussion about how private credit is supplanting bank capital, public debt. It is becoming increasingly a place where you have to have exposure in order to have a real suite of credit and debt exposure in your portfolio. Infrastructure, the same thing. And then the other part that's happening, in order for that to become real, you have to have products, you have to have structures that allow a broader range of investors to get into these private markets. And so what you're seeing is the emergence of these evergreen vehicles, these semi-liquid products, which are allowing more investors to get access into the private side in order to take advantage of the fact that it is now where a lot of these opportunities are being found.
So Blaine, we're in the third year of a bull market rally for public equities, but we've recently seen Goldman Sachs come out and say that they expect the S&P to generate about 3% a year over the next 10 years. What's your outlook for public markets looking forward?
Well, Steve, the S&P 500 is up about 70% now from the October low 2 years ago. Valuations are now the third or fourth most expensive in the last 100 years, depending upon what PE valuation you're looking at. I'm definitely not going to call a top in the public equity markets, just given how healthy the credit and banking markets are right now. But I think, to get further gains, which are probably likely, you need to deliver earnings growth through that S&P 500 suite of companies. The relative valuations of big versus small companies are very wide right now. After the election, I calculated that large public non-financial companies are trading about 19 times total cap to EBITDA. Now that compares with profitable small cap non-financials trading 11 to 12 times EBITDA. Now, also keep in mind that private company buyouts typically are occurring at 10 to 12 times EBITDA. Larger buyouts are happening 12 to 14 times EBITDA. So, if you look at those valuation differences just between the biggest public companies and then the smallest public and even private companies, it's very wide today. If you combine the high multiples of large caps with their balance sheet strength, there's plenty of M&A firepower potential to merge those two valuations together. A catalyst now could be the change in the FTC, Department of Justice, as a result of the recent election, a strong economy and improved earnings outlooks for all of the companies, given the changes in tax rates and lower regulation, could also help spur some of that convergence in valuations. We're already starting to see an uptick in deal activity just in the last 2 weeks during this holiday season. One of my favorite charts is of the high yield credit markets. It shows spreads near all-time lows right now. That is going to provide plenty of borrowing capacity for potential M&A deals in the future. This could be a pretty big tidal wave of M&A activity we're looking at next year. So, if the outlook for equities is continuing good, the outlook for private equities is even better.
Great. So, Mario, for those investors who've been really happy with their public market returns of late, why is now a good time for them to be considering adding or increasing an allocation to the private markets?
There aren't a lot of advantages to being old, but one of them is that you've seen a few things in your life and you hope that your memory still works and you can remember what happened around that. We have a lot of periods in the past, 99, 06, 16, 17, where public markets were doing really well and private equity was doing fine, but it wasn't doing as well as public markets because public markets had a great year. And the question you asked is the question I always got asked, is why should I invest on the private side? The publics are doing great. The publics tend not to do 20% a year for the next 10, 20, 30 years. They just don't. And as you said, and as Blaine pointed out before, you tend to have periods where publics go up and then they go down. And what you have at that point is you want to be in the private markets. And what I talked about earlier, where the opportunity set is there, combined with the fact that if you take private markets, private equity in particular, over the last 30 years, they've outperformed the entire time. And there's probably, if you think about that and say, is that going to happen the next 30 years? Nobody really knows. But the odds are pretty good that if something's happened for 30 years, it's a trend that probably will continue. And for me, as I look at that, and as you think about where you want to be investing, you don't want to have everything on the public side. You need that private equity exposure. The other thing I will say is, everyone says to me, well, interest rates are high, and this is happening or that's happening, leverage. Part of the reason why private equity works better than public and outperforms is a governance model. It just has better alignment. It has better governance around how it works. Being a public company is hard. Being a private company doesn't have any of those things associated with it. That's what drives the outperformance. So when you think about what will happen over the next 10 years, nobody really knows. But I do think as you look at the governance model, as you look at some of the structural things around private equity, as you look at the opportunity set, you have to have it as part of your portfolio.
And so if we build off that last question, Blaine, coming to you, the IPO market remains relatively shut. And so given your public markets background, how do you think about the private equity opportunity in a world where the IPO market remains shut and the current market environment that we're sitting in today?
Well, if you look at the public markets, since the election, they're seeing a record amount of inflows into both mutual funds and ETFs. Right now, the numbers I saw from last week on a 4-week trailing basis, it's running, positive $40 billion a week. So, that's money that's just coming into the public equity market, lifting valuations since, as you said, there are no IPOs. At some point, the valuations, the public markets will create enough of a halo to where, people will want to take those private companies public. Just the flood of money in the month of November alone lifted the S&P 500, I think 6%, and mid caps were up 9%, and small caps were up 11%. So nice halo. I think that this continued stretch of valuations will put pressure on portfolio managers to find new companies to want to buy. And there's definitely a shortage of high quality new public companies out there. One of the companies I like to point to is the recent IPO of Standard Aero. Here you had a GP who had a very high quality, very predictable business model, high margins, that was maturing in his LP portfolios, and the GP looked to sell that to another group of GPs, but the valuations that they were getting back were only coming in 11 to 12 times EBITDA. So they decided to look to the public markets, and the public markets again saw this great little gem of a company, and they said, we'll pay 14 times EBITDA for that. And once it went public, they ran it up to 17 to 18 times EBITDA. Now it's settled in at 15 to 16 times after a couple months of trading, but still that's 40% higher than the GP would have gotten had they sold it to other private equity buyers. I just think that there are PMs that want to invest in newer companies. There are PMs that want to invest outside of the S&P 500, especially because those top 10 stocks of the S&P 500 are making up 30% of the market cap of that index. So just blind money going into the market is concentrating in these very large mega cap names. You're also getting lots of AI, data, cloud centric exposures when you're investing blindly into the public markets. And more PE to public company conversions will allow equity investors to get a lot more diversification across many other industries. So, if the IPOs don't come back strong, there's plenty of private and public capital looking for deals in the future.
Yeah, if I could just add one point to that, to echo some of what Blaine said, because I do think there's this notion that if there's no IPO market, then there's no exit opportunity for the private equity industry, therefore it won't do well. In the buyout world, only about 5% of exits are through the IPO route. It's attractive, it can be attractive, but I think people just need to appreciate that in the venture world, it is an IPO-related market. But in the buyout world, it is deals to other private equity firms, it is deals to strategics. And so the IPO market being robust helps people feel better. But I do think people need to understand that an IPO market is not why private equity generates returns. So it's a great enhancer. It's obviously important on the venture side, but on the buyout side, which is at 80% of the market, that's just not where you get the exits. So I do think that's an important point to keep in mind as people think about, oh, are there IPOs? Therefore, is something good happening on the private equity side? It just those two are not related in that one-to-one sense.
Now that we've got a good picture of where the private and public equity markets stand, let's zoom out and look at some of the big changes that happened politically and talk about what they could mean for the private wealth audience. So Mario, what impact do you think a second Trump administration and Republican wins in the U.S. elections will have on both the private and public markets?
Well, I think you certainly saw what happened on the public side the day after the election. I think that what the public market and also the private market looks at from the positive side, it says, look, we are clearly going to go into a less regulated environment. Blaine talked about it earlier in terms of the restrictions on antitrust, on transactions. That is probably going to go away. In terms of any fiscal taxes going up, anything that has a friction cost associated with deals, I think it is a much more favorable environment for capital formation, whether it's public or private. And I think the markets have reflected that. And I think when Blaine talked about the deal activity increasing already, it's a reflection of that. People are saying, good, we will have a less regulated environment, a better fiscal environment to do deals and for businesses. Businesses will just have a freer hand. So I think that's the positive. I think what people just don't know is, will tariffs increase friction cost? How do you factor that into how you think about what's going on with your company? How do you think about that with what's going on geopolitically? And what happens with interest rates and inflation if the US economy is growing at a faster pace than we may have anticipated a year ago? What happens with that? I don't think we know. I mean, if you remember in the first Trump administration, the first year, the market was up very strongly, and then it went down the second year and then was better in years 3 and 4, although you had the pandemic, obviously. So I do think the markets have reacted positively. I think both public and private. I think that will continue for a period of time. But we have to see what happens in terms of what legislation actually gets passed and what that regulatory environment looks like. But I think right now the markets have clearly said it will be a net positive. And so you will see more deal activity. You will see more money flowing into both public and private markets.
And so if we move beyond the election, what other geopolitical factors are top of mind with you today when you think about the markets?
Well, I would say certainly I'll use it under the rubric of tariffs. There is clearly a geopolitical question around the US and China and what happens around that. When you think about investing, it used to be 20 years ago, you could have, Apple was the dominant company around the world in phones. I don't think you're going to have that world anymore because the US and China will define certain industries that are national security issues. And so you're going to have spheres of influence. And I think as an investor, you have to be aware of that. I saw this morning that China has just restricted a bunch of minerals that are required for battery production. As an investor, you're going to have to think about where are those things going to play out and how are we going to invest, whether in a geography or in an industry that might be affected by that. I don't think we know. It's very hard to invest with an idea that, oh, I think geopolitically this will happen, therefore I'm going to do this. I think you have to be aware of it as you think about whether public or private, where you're investing and what that means around the geopolitical issues.
What's the thing that surprised you most in 2024?
One of the things that surprised me this year was just the lack of very high profile IPOs, especially some of the larger private companies that we know that are out there that could go public, say, Stripe, also Databricks, which just recently raised a lot of money. And these are companies that are transitioning from money losing to now generating profits. They have a lot of employees that would like to cycle through some of their equity holdings personally. And rather than going public like they used to 20 years ago to raise money to help employees or to get capital for internal uses, they're now just pick up the phone call and making a few rings to some private investors and raising the capital that way. So they keep pushing out the timeline of going public. Stripe even in their annual report said maybe they don't need to be public. So that's kind of crazy thinking here's this great $100 billion market cap company that may never go public. I was surprised that we didn't see some of the bigger ones, but I think the world is good, the economy is good, companies have other ways of raising money rather than calling the New York Stock Exchange.
Yeah, I would just let me say, see, Blaine, that's why people need more private exposure because these companies just aren't going public, and so they're going to stay that way. I think that's probably a trend that will continue. One of my biggest surprises, and it shows how the range of investment opportunities is going to shift without people even realizing it, is actually in the infrastructure space, where the United States has always been anti-nuclear energy, just because of a variety of things, but it's always been anti-nuclear energy. You can't have that. This year, Microsoft says they're going to open 3 Mile Island in order to supply AI centers. And I think you can probably see out this window. 3 Mile Island is way out there, but it is unimaginable to me that that could happen. I would have never thought that we are going to have nuclear energy as a core component of U.S. energy policy, driven, by the way, non-governmentally by Microsoft. And I suspect you're going to see a bunch of little modular nuclear reactors going up in the United States. Completely different world from what you thought 2 years ago. And again, as investors, particularly on the private side, those are the kinds of things that you just can't predict, but you've got to be around for that. The other surprising thing, I'll just add, I know it was one, but I'm going to cheat and do two, is the idea that banks are now lending to private credit firms to then take the money and lend it to the customers the banks used to lend to. I mean, when you talk about a structural shift in an industry where private credit will now become a much, much bigger part of the landscape, that tells you in a nutshell how dramatic a shift that is, where all of a sudden the people that were here, the banks, are now lending to the people to give it to the bank's former customers. I would have not thought that a couple of years ago, either one of those developments.
Outside of the U.S., what do you see as major potential market shifts in 2025? What should we consider and keep in mind?
In the non-U.S. market, I mean, let's start on the private equity and private credit sides. The U.S. market is clearly the largest of the markets in those two areas. Yet, when you look at, for example, European buyout, it has typically performed as well, if not better, than U.S. buyout. So from an investor perspective, you have to be looking at these markets and figuring out how do you want exposure to them. And presumably, as private credit becomes a larger share of the U.S. market, it will increasingly become a larger share of the European market. With that said, and I know it's going to sound like a home bias because I'm in the U.S., if you have a situation where the U.S. is probably growing a little bit faster than most other parts of the world, Europe in particular, then it probably will favor a U.S. private equity or private credit environment. And I suspect that will be the case for the next couple of years. But again, as Europe begins to develop a little more energy independence, as Europe begins to become more of a player in the AI sphere, then I think you will continue to see opportunities around Europe. Asia's a little trickier in the sense that this is the first time in my career where you invest depends on where you're located. As a U.S. investor, it's very challenging to invest in China because you don't know what the rules are, either in China or in the U.S. And so I think there is an enormous opportunity for non-U.S. investors to be investing in Asia, China in particular, because there is relatively less capital that will be flowing from the US and parts of Europe into China. So again, it depends where you're located in terms of how you're going to invest around that. And as Blaine has pointed out, the multiples outside the US are lower. So you are getting companies that are comparable in some cases to US companies in terms of the industries they play in at cheaper prices. And that does matter at some point. The other place where I don't think it matters where you're investing because the opportunity set is so large is infrastructure. I think there, while there are interesting opportunities in the US, it is much more of a global place to invest. And I don't think that you have this situation where the US happens to be, like in credit and buyout, a larger place, therefore it takes more market share. I think infrastructure will increasingly, as it has been, be a much, much more global opportunity set.
As we get close to year end here, do you have any year end recommendations or things people should be thinking about heading into next year?
I think it's really important to separate one's personal feelings from one's investment decision-making process. The election may have not gone the way that you thought it was going to, but your portfolio still needs to stay focused on generating the best returns that it can. This new White House is going to cut taxes, both personal and corporate. It's also going to ease many restrictive regulations. This has already caused stocks and credit to surge higher this month. With a DOJ and a FTC even less likely to stop mergers going forward, there should be a frenzy of deal activity. I really don't see why 2025 can't be the first or second best M&A environment ever. This is going to help all undervalued assets, both public and private.
I think one of the things that we tend to do, I do it. The question I've been asked more than any other in the 30 years I've done this is now the time to invest in X, whether it's private equity, private credit, whatever it is. And the reason you get asked that question is we're all market timers. In our hearts, we all believe we can time the market. I believe it. 30 years of doing this would suggest there's no evidence that that's even true, but I believe it. You believe it. We all believe it. And so you get asked the question of, is now the time to invest? You asked me that earlier, Steve. And I think the thing that I would reflect on is, yes, we've had a change in U.S. government. And yes, it will impact for some period of time. But we're all doing this for 5, 10, 15 years. And nobody really knows what this will look like. But you do know that history says if you've got a well-diversified portfolio, and that includes private markets, you're going to be fine. And so I think we do need to sometimes step back and say, okay, I want to do something dramatic. I want to do something really important and change something, but do you really? And I think the answer is probably not. You want to keep investing, probably a little more on the private side than you have in the past because you've got more opportunities and you've got more structures and vehicles to do it. But I don't think you want to be looking at this going, oh, wow, I'm now going to dramatically shift this to 80% something, whatever it is you're doing. It just seems to me that that's how the most successful investors have been successful. And I don't know why it would be any different today.
So that concludes our webinar for today on the 2025 Private Markets Outlook and Public Market Implications. Thank you very much to Mario, thank you to Blaine, and thank you all for joining us.